Hi everyone, my name is Randall Mauro with RESNN Investments, and today we're going to talk about how to invest defensively in the stock market. And the first thing I want to cover is what makes an investment defensive. And the best way to look at this is you want to invest in companies that are stable and safer. These are companies that are going to have lower risk. They're going to have less chance of a negative impact in a bad economy. They may be selling a product that is more stable or more essential to the average consumer. And so they're going to have consistent results. They're also going to be less volatile. So they have a more steady business model. There's fewer surprises in both directions. They're not going to have a bang up profit quarter like a high growth company. They're also going to be consistent when there's a heavy decline in the market caused by a depression or recession where a lot of people are out of work. And the last is it's important to consider correlation. A good defensive portfolio works hard at this, where you invest your money not in one safe sector, but rather in many. And by doing so, if one sector is impacted negatively, the others are holding up steady. And a good example of this is during the COVID crisis, healthcare stocks fell pretty hard. Generally, healthcare is considered one of the most defensive type of investments. Yet in this situation, it was impacted negatively by the bigger picture. Which sectors are stronger or safer? Which sectors are more defensive? Well, if you check out my other video on what are defensive investments, I break down the 5 in the stock market that are resilient to market downturns. So how do you decide between defensive and aggressive investing, or somewhere in the middle? Well, there's basically 4 different things to consider, and they're specific to each person. And the first is, what are your investment goals? Are you in a place where you're focusing more on preservation, or are you focusing more on growth for your investments? Obviously, in preservation mode, you're going to want to be focusing on more defensive type of investments. You're less concerned about getting the best return out there and more about making sure all that money sticks around. The second is risk tolerance, and I call this the sleep factor. Are you going to wake up in the middle of the night in a pool of sweat, terrified that you're going to lose all your money? And if the answer is yes, then you probably want to move more towards defensive investing. In the dot-com crash of 2000 to 2002, yes, it lasted 2 years, the NASDAQ fell 78%, and it took 13 years to come back to break even. But over a long period of time, it returned much more than a defensive portfolio. So you have to weigh that. Are you comfortable sitting for 13 years? And are you comfortable in a stock that could fall 78% in order to get more return? And there's no right or wrong answer. It's only the answer that works for you. Kind of related to that is your time horizon. Obviously, the longer time you have, the more buffer you have from a market decline in an aggressive stock. Using the example I just mentioned, where it took 13 years to come back to break even and fell for 2, so you're talking 15 years of time. Obviously, if your time horizon is less than that, then you probably want to consider that. But if you're investing in a retirement account that you're not going to touch for 30 years, well, then it probably makes sense to go for that home run type of investment. Lastly, you want to consider your financial situation. Can you afford to be aggressive? Obviously, if these investments are going to impact you negatively if they lose in value, then you probably want to skew more towards defensive. Obviously, you never want to invest more than you can afford to lose. And lastly, when you're creating your portfolio and deciding on defensive versus aggressive investing, you do want to consider the tax consequences of the investments. And generally, you want to put your more aggressive investments into a Roth or retirement accounts where the taxes are going to either be non-existent for these high growth returns, or they're going to be deferred to a time when you're making less money and therefore you're going to have a lower tax impact. Whereas the defensive investments, you want to put into those taxable accounts, certainly the funds that you're going to potentially need in the shorter term as well. So does defensive investing work? Yes, these type of investments do fall less than the overall market in a market decline, but it's obviously a little more complicated, and it should be specific to each person. Defensive investing may be safer, but is it smarter? And that's the question only you can answer. That's all for now. Thank you for your time. Safe investing to you.